Still with us, Julian Emanuel of BTIG, who likes energy. Tell me how, tell me why, at what price?
Fantastic. So we'll think of it this way.
It is fantastic.
Yeah. When we put our year-ahead outlook out in early December, we used what the strip was pricing for year-end, $55 in WTI. And we felt very nervous about being too bullish. And we know that everyone's number was lower than that. So now here we are, pushing $60 again, basically. And to us, it's sort of this perfect storm of things already priced into the market. We know the long-term story about the switch to electrical vehicles, but that's a long-term story. We know that Norway is divesting its holdings in energy shares to a certain extent. That was talked about 2 years ago. So that's really sort of a sort of sell the rumor, buy the news to us. And the last thing that we know is the combination of all of those has caused energy to be 5.5% of the weight of the S&P 500 versus an historical average closer to 10%. It's a recipe for an upside in an environment where, if we're right about the China stimulus, and we're right that there's maybe even the tiniest bit of clarity on Brexit sort of supporting Europe, energy shares really look very compelling to us.
So I get it on like a value basis, but it feels like the underperformance of energy shares to the oil price has been pretty sticky, and there's nothing that I see in my reporting to think that that might change anytime soon. So do you think there's upside even if it doesn't catch up with the strip price?
It's really this psychology. It's the same psychology that has caused, a vast majority of investors that we speak to essentially have been fighting this rally in the broad stock market since December. You take all of these things and combine them, the long-term outlook, the fact that oil prices have already overshot most people's expectations, we do see that there's going to be a catch-up, particularly as the data in the U.S. start to stabilize, confirming our view that the first quarter is indeed a soft patch, and the number for the full year GDP is going to be north of 2%.
So what does that mean then for volatility? Because a lot of CEOs I talk to are looking at more volatility in the oil price, but we're not necessarily seeing that in the index. So if you come inside the Bloomberg, you got the VIX, you got the MOVE index, you got FX vol, and you get oil volatility, obviously all pretty low. What do you do with volatility?
We think that in general, in an environment where, if you look back to the beginning of 2018, you had a number of volatility spikes. You're in a world of geopolitical uncertainty. You have elections in 2020. Asset price volatility in general is too cheap. We think volatility moves higher.
What about the long-term disruption in terms of renewables?
It's definitely an issue, but those are the kinds of things that they're phase in.
Well, over what period of time? In the way you announce, is that 2 years? Is that 5 years? Is that 10 years?
I would say it's measured, 10 years, a decade type of thing. Yes.
So when you say talking about volatility, does that mean that you want to be buying vol here, or you want to be selling it? Like, what's the right trade for you?
Well, for us, so if you think about it in terms of the equity market, we've come a very, very long way. There's no question about it. And obviously, with the 3,000 price target for year end, we think we're going further. But options are so cheap that if you're adding exposure right now, you really want to do it by using options. And look, let's face it, a lot of people have good profits year to date so far, much better than they would have thought. Downside protection inexpensive too.